Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone, and welcome to the webinar on getting tax write-off on a W-2 income. We all know a lot of sources of tax write-offs in terms of passive income, so passive losses, which is also called depreciation. But there aren't a whole lot of ways in which you can write off active income or W-2 income, 1099 income, capital gains, those kind of income, right? So I'm Kavita Baratake, and I'm a passive income coach and founder of Cherry Street Investments. And I'm here with Eric Rice today, who's the Chief Growth Officer, I believe. I think I got that wrong there. I meant to type growth and I somehow wrote operating. I apologize. Of the King Operating Group, which specializes in oil and natural gas exploration and production. Eric started his business career in Chicago in wealth management for high net worth clients before spending almost 2 decades building his own businesses. Along the way, he worked with founders across multiple sectors to create profitable, enduring enterprises. Some key takeaways that you're going to get from today's webinar is it's going to provide you with an educational overview of the oil and gas industry, also insight into what to expect in the market in 2023 and beyond, and how to use your investment to create or reduce your W-2 taxes by 100% of the investment amount, not almost, but 100%, and ways to de-risk oil and gas investments, and also talk a little bit about how they structure their funds for investor alignment. So I'm looking forward to this discussion today, and I'm honored to have Eric and Cole join us from King Operating.
Thank you for having us. Appreciate you hosting this event for us, and we're happy to be here.
Thank you. As always, I usually host this webinar for educational purposes only. Eric will allude to some of the investments that they have. I always tell people to do their own due diligence and talk to their own attorneys, financial advisors, or CPAs for all legal, investment, and tax matters. A few housekeeping rules, and I'm going to hand this off to Eric in a few minutes. So everyone's on mute. If you have a question, please type it in the Q&A box. You can locate it in the bar above the app, or if you're using the browser, it should be there as well. Please don't type your questions in the chat box. It just becomes really hard to track the questions. And we want to make sure everybody's questions are answered. This webinar will be recorded and the link will be sent out in case you feel like you need to revisit some information. The webinar is always recorded. To avoid these from going to spam, please make sure you add my email, which is Kavita@Cherry Street Investments, to your contact list. Just a few words about Cherry Street. Too much verbiage here, but just the gist of it is I do a lot of education on through regular webinars in real estate investments, alternate investments like ATM machines, taxation, asset protection, and today we're going to talk about oil and gas investments. Also provide opportunities for passive investments to create income in real estate and alternative investments, and also have insurance, high cash value business. So where you can use an insurance policy to actually invest into real estate and alternatives. If you're interested, you can join my Facebook group. It's called Purely Passive Investor Group. We have almost 1,000 members here. And so I do share a lot of information about investments, and other people post as well. I also host a YouTube channel. You can subscribe, and all of these webinars, plus I'm doing a lot of short videos like shorts, YouTube shorts, to talk about various topics that come up with investors all the time. So you'll be auto-notified on uploads. If you want to go check out my YouTube channel, it's bit.ly/cherry-street. We have some upcoming webinars in the next few weeks. Every 2 weeks, I usually do webinars. So the next one will be Feb 9th. We'll talk about multifamily investments during a market slowdown and how sponsors are handling it, what kind of challenges they're facing. So you can ask your sponsors, if you're investing in multifamily right now, the right questions. because things are changing and we are in a tough market this year. So you guys should be prepared as well. We want you to understand what happens on the other side of the equation after we buy a property. We also will talk about creative financing, how to owner finance and seller finance deals in this market to get really low interest rates. We have a seller financing guru, Dan Diaz, coming to talk to us about that. So the best time to buy real estate is when it's down, and it's going down. So we haven't had this opportunity in 12 years. So I want you guys to be positioned to take advantage of this. We also have in March, same rental, more income. We'll talk about how to manage midterm rentals instead of going long-term rentals. And we have another amazing person, Vivian Keller, talking to us about this. And I'll have more topics coming up as the year progresses, but these are the ones which are fixed right now. I hope you guys can join me. A little bit about me. I am from Bangalore, India, moved to the US in '98. I have a master's in computer science from A&M, so I didn't go too far from Aggie land. I've spent 20 years in the technology world across various companies, became a real estate investor and never really looked back. Retired myself and transitioned to full-time real estate. I work in a lot of you guys know me. I do a lot of different investments. Some of my deals so far, like I mentioned, we're doing some land development in Austin as well as Salina, besides a lot of apartments, senior living facilities. And currently, we have a couple of opportunities open. If you guys are looking at investments to make, of course, these provide passive losses, not active losses, which is very different from what Eric will talk to us about. But that can still be useful for offsetting passive income, including the income from the fund itself. So you kind of get a tax-free income source if you want to create some passive income. We have an ATM fund and a car wash fund open right now with great cash flows and high IRRs. So if you're interested, please reach out to me. And I'm going to hand this off to Eric now and let him take the show.
All right. Well, keep me on track, Kavitha, because I want to make sure that I am following your agenda to the T if I can.
Sure.
Where would you like me to begin?
If you have a slide, you can start there. You can share the deck, or if you wanted to start with where we are with oil and gas and, talk about the overview of the industry as well as what to expect in the market, that would be great.
Sure. I mean, that's what I'm entrenched in all day. I'm going to stay away. I know we're going to try to keep this completely educational tonight. So I want to make sure that we're not interfering that with our presentation. But for your investors, the folks on here, number one, thank you all for coming tonight. We appreciate you spending time on a Thursday evening. I know you have families and things to get to. So I want to make this as valuable and useful as I possibly can for you. And the best way to do that is to tell you factual, truthful events that are happening around the world and allow you to determine whether or not oil and gas or multifamily or car wash or anything like that, you just need to know. The world needs to know. And I've been doing this for a very long time. So if we look at the world and we look at and scope energy, right? Energy is at the core of everything that we do, whether you're a human being, you're a plant, you're a company, an airline. Energy is the most important commodity on planet Earth. Without it, we cannot get any other commodities. So before I get into oil and gas, which is going to be a very methodical breakdown of factual events that have happened over time and will help you understand where I believe we are in the market. And I will start by saying I'm not a tax advisor. I'm no longer a financial advisor. And my opinions are my own. They're not of the firm, although I would say that 99% of the people working here would agree with me. But these are things that I do on my own. So the market itself right now, we find ourselves in probably the most interesting times in all of human history. And I say that in a very broad sense. Almost everything around the world is confusing. Whether it's politics, education, the financial markets, lending, banking. I mean, there's just so many strange things happening right now. And of course, there are many different conclusions you can draw from this, but we want to keep it very much technical and focused in on economics. So economically, where are we right now? Well, to be honest with you, we're in a recession, and we have been in a recession for about 3 quarters. Now, that's despite everything that our government institutions will tell us. I think that people are losing faith and confidence in government institutions and the information they're giving us. And I believe that they have every right to do that, especially in a free nation. We have the right to question things around us. One interesting thing that I'm going to start with today is something I've been talking about for about 3 months. And it's just now coming out, and Fox News and a couple other publications started talking about our most recent GDP report. So our gross domestic product report. This is a really important benchmark for watching an economy. This is the overall money transacted within the nation. Now, if we look back at Q1 through Q4 of 2022, we will see that Q1 was neutral, a 0% growth, which I don't want to allude to anything here, conspiratorially. But you have any idea how difficult it is to get a 0.0% number on a GDP? It's extremely difficult to land on an even number. But I digress. Q1 negative or neutral. Q2, Q3 negative and negative. Now, traditionally, that means we're in a recession. 2 consecutive quarters of GDP reduction generally means we're in a recession. Now, Q4, of course, came out right at the end of the year, right before the midterm election. It showed a 2.6% growth in the GDP of this country. Now, again, I read this report because I'm a boring person, but I read the report, and 3 months ago, I said, this doesn't actually give a depiction of where the American economy is at the moment, because the 3 largest indicators on that GDP report that got us into that positive area, and again, I'm not going to allude to anything, you can do this on your own, right before an election, okay? Keep that in mind. The largest export of liquid natural gas in this nation's history occurred. That was one of the largest driving factors. One of the largest sales of weapons to NATO nations occurred, and strategic sales from the Strategic Petroleum Reserve occurred. Those 3 things do not impact the American economy at all, but they do make a GDP report look great. So earlier today on Fox Business, Larry Kudlow came out and broke this exact same thing that I've been talking about for months down for people, said the same thing. And he noticed one really specific indicator in there that I missed. And that was for the first time since 1932, which is the worst year of the economic depression in this country. U.S. consumer discretionary spending dropped $1 trillion. So there are now $1 trillion that aren't available for that discretionary spending, the extra pack of bubble gum in line at the grocery store or what have you. Now, knowing that we're in a recessionary trend and we're seeing, inflation, by the way, this is something most people don't know, the CPI, the inflation index that we use, hasn't been updated since the early 80s or the late 70s, but they can't even determine which date it was actually updated. So we're looking at 40-year outdated economic information. True inflation is things you can measure on your own. How much do eggs cost right now? How much does gas cost? I know they're saying it's cheaper, but it's still 65% more expensive than it was when I moved to Texas in 2020. So you look at those things, and we're really sitting in a very high inflationary period while interest rates are rising. And since most of you are probably real estate investors, I'm sure that you're feeling the pain of that more than anyone. The cost of borrowing money. And for those of you who don't know how it works, when inflation rises, it doesn't necessarily mean, now this time around it does, but it doesn't always necessarily mean that the cost of everything is going up. It's the value of the currency is decreasing. That's the real issue, because there's too much money in the system. We've printed, I think the number is 48% of all available US dollars in the world have been printed in the last 4 years. Okay. And to let you know how this works, because we keep, we get programmed into thinking, you remember $1 million used to be a ton of money. You remember that could be I just want $1 million. Well, $1 million doesn't get you very far. Then it was $1 billion. Now it's $1 trillion. Do you know what comes after that? Is a quadrillion, right? So now $1 trillion is commonly used. We always trillion here, trillion there. So let's break down money, a dollar, into a second. Okay. If a dollar equaled 1 second of time, $1 million would rewind the clock 12 days. $1 billion would rewind the clock to 1972. $1 trillion equals 32,000 years. So that compounding, when we start using terms like trillions of dollars being printed by the Fed, that is putting so much money into circulation, it's lowering the value of the currency. That's what creates quote unquote inflation. So the way that our system, which I disagree with a lot of it, but the way our system works is that when that happens, the Fed will stop printing money for a period and start raising rates, making it more expensive to borrow this worthless money. Does that make sense? So as they do this, they're creating a false strengthening of the US dollar. And we're living through this, especially real estate folks. You are really, really in this. You've gone from my mortgage on my house is 2.25%. If I were to refinance right now, it'd be 6.5%, 7%. So it costs more to borrow the same money that's losing value. It's a kind of an illusion. Now, in the middle of all this, we're starting to see a lot of pressure put on certain industries, agriculture, real estate. Jobs numbers are big indicators in the market. These things aren't accurate. We keep seeing these jobs reports that come out and 500,000 jobs were created, 200,000 jobs were created. Well, the head of the Philadelphia Federal Reserve just left his position, and on his way out, he said that all of these numbers are incorrect. The actual number of jobs created in this nation last year was 10,000. So they're off by quite a bit. We now know the GDP is off. We now know the jobs numbers are off. So it puts us in a position where we have to look at where this is going, right? So that's kind of where we are. But where is this whole thing going? Well, we're going to be looking at market corrections all throughout the world. If you haven't heard of the BRICS nations, they're forming. It's Brazil, Russia, India, China, and South Africa. And now Saudi Arabia is looking to join, along with Argentina and Peru and a bunch of other nations. What's happening around the world is it's the West versus the rest. The United States has been imposing sanctions on people for so long. Other nations are kind of tired of it. And we're starting to see for the first time in my lifetime, a real competitor to the US dollar. And the whole strength of the US dollar, the main purpose of it as a global reserve currency is for the purchase of oil. So if we look at how markets kind of centrifuge and where they come in somewhere in the center, everything revolves around money and energy. So when the US dollar is being weakened and strengthened and people are trying to create an alternative for it, you have to look at what does that mean to me as an investor? Where do I go? You want to go into a commodities driven world. I mean, that's where we're headed. Things that are tangible and real. The stock market itself just had the worst year since I think 2008. And if you read any analyst report, which some of them have a good reasoning behind their calculations, others don't. But most real analysts will tell you that this upcoming year in the stock market is going to be just as bad, if not worse. The bond market, which rotates on the power of the US dollar, is an absolute triage at this point in time. So we find ourselves in a cycle of investing, of saying, well, the stuff that I normally do isn't logical right now. What is logical? For me, I've been saying this for about 2 years now. I invest in physical gold, physical silver, oil and gas, raw land, and Bitcoin. And Bitcoin I won't get into because you could use any cryptocurrency as long as you've done your research and you know what's valuable and what's not. But like you're doing in Salina right now, you're developing raw land into something new. There's value in all of that. But the traditional flipping houses based on interest rates and market cycles is going to be very difficult in this coming year. So at the end of the day, we have to look at the energy market because that's kind of the baseline. You can't build an apartment complex. You can't run a store. You can't even drive to work without gasoline. Everything in this world rotates off energy. Now, the energy cycles that we're looking at right now are very easy to see if you're paying attention, but most people aren't paying attention. So I'm going to give you kind of a timeline. Joe Biden got into office, and this is not a political tirade. These are factual events. I am not a Republican. I am not a Democrat. I am an American, and I seek the truth. That is what I do. So Joe Biden took office, and day one, he canceled the Keystone XL pipeline, which removed a lot of jobs, but more importantly, it kept a lot of hydrocarbons from flowing in and out of this country and trading between Canada. Then he shut down federal drilling leases in Alaska, Utah, the Gulf, and the Atlantic. All subsequently are huge areas for us drilling and producing our own energy sources. Now, before he took office, we were what's called energy independent, meaning that we had the ability to produce enough oil on our own. And by the way, America uses 18.6 million barrels of oil a day. 18.6. We were producing 12.9 million barrels of oil per day. We're now producing a little over 10.5 million barrels of oil a day. So we have a very large deficit in our daily production. So after shutting down the federal land leases, he imposed taxation upon oil and gas companies to promote a green energy, the Green New Deal, they're calling it. Well, these things have failed over time. So I'll give you a quick and dirty rundown of the green energy sector. Over the past decade, 10 years, $10 trillion has been invested into this sector. When that investing began, oil and gas and coal accounted for 87% of the world's energy, 87. After 10 years and $10 trillion, they've reduced that number down to 86. So we're starting to see this massive reduction or pullback on green energy investing. ESG is being pushed back by states all over the country. One of the most interesting things is that the state of Wyoming recently, where we have some really large operations, they actually are going to ban electric vehicles in Wyoming in 2030. to support the oil and gas industry, because we've seen a lot of states like California saying they're going to ban combustion engines by 2030. So there's this battle occurring in energy. People are starting to realize that green energy is a feasibility, but not a probability. It's feasible. It could put a dent in what are called fossil fuels, but we're seeing that the reality is not matching with the dream, right? Like we all have this vision of things, and eventually you have to wake up to the reality. Like I wanted to be a 7 foot tall basketball player, but eventually I had to wake up and realize I'm not going to be a 7 foot tall basketball player. That's kind of the green energy space. The dream is not matching the reality. But at the same time, we're also starting to see the importance and how crucial traditional hydrocarbons are to production all around the world. Now, as we go through this timeline, in the beginning of 2021, Joe Biden shut down these drilling areas, the pipeline, and then supply got so bad in this country, we started seeing this big run up in gasoline prices, which affect everything. If gas prices are higher, it costs more to ship a product from Amazon. It costs more to make a product. Everything costs more with higher energy. So as this happens, we started to see a deficit. And then the Biden administration went to Saudi Arabia. And this is really important information to understand where oil and gas is. He went to Saudi Arabia and tried to beg OPEC to get a higher production level in oil so we could buy their oil to meet our deficit. The end result was, when he came back, that they not only didn't raise their production, they reduced it by 2 million barrels a day. That's a significant amount of oil daily in production, 2 million barrels. So then they actually produced a report from OPEC stating that Biden had reached out and said, well, don't tell anyone you're going to reduce production until after the elections, right? So we have a GDP, all this stuff revolving around political activity. The world is far too political, but it does impact us. So then we also had a scenario where one day, about a month afterward, is in December, I forget which day, but there was a day in December where I got to work and the price of oil had dropped $5 a barrel. That's a significant drop in our pricing. And I looked around online and I found out the Wall Street Journal produced an article that said, well, OPEC Plus said they're going to raise their production level by 500,000 barrels a day. 3 hours after finding this article, OPEC Plus came out with a public statement and said, yeah, that's all a lie. We didn't say that. We're not increasing our production. And oil went right back to $80. So there's manipulation that does occur from geopolitical events in every commodity on earth, whether it's gold, silver, oil, zinc, it really doesn't matter. They all have this political influencing of their supply chains. So in the midst of this, those are kind of the bullet points, but we have a very severe internal domestic supply problem in America. And that comes from many different things, including a lack of investment into US energy. Now, we're also seeing this supply in Russia and Saudi Arabia. They're now 2 million barrels a day less than they were 2 years ago. So at the same time, in China, they've had these zero COVID lockdown policies. It's kind of like a perfect storm for oil and gas if you look at this the right way. Horrible storm for the world, but perfect storm for oil and gas as an industry and as an investor. Now, China has zero COVID lockdown policies. What this means, very simply, is that they test every single person that lives in a province. If one person has COVID, nobody gets to leave their home. That's how it works there. They're just now beginning to ease these regulations, but this is locked down, the numbers we don't know, it's China, but the estimated numbers are about 300 million people haven't worked, gone to school, driven a car, they're getting all their food delivered to them if they have food, but these people are all getting released from their homes. When 300 million people drive to a new location that hasn't been operational for months and turn it on, they're going to need energy. And that energy demand is going to be a very big strain on the overall supply lines from not only America, but Saudi Arabia and Russia, because they're just not producing the oil. So we're approaching this time in history for the first time in a very long time where supply is underneath expected demand. Now, the expected demand out of China will increase. It doesn't sound like a big number, but it'll increase the demand for oil supply by 4%. That's about 4 million barrels per day. So as an economist or an investor in oil and gas, the thing that I'm excited about is the fact that we are approaching a commodity-driven market, right? When you're not investing in lending and you're not investing in equities or derivatives because they're all getting destroyed. People are turning towards commodities. So which commodity do you invest in, right? I'll never be a non-advocate of oil or of gold and silver. I mean, those are the most traditional forms of money. But where do you make money? And those are stores of wealth. You're not going to make a fortune on that stuff. You're just going to not lose. When you have a falling US dollar, and I've been saying this for a long time, I've been called crazy for a long time. Not too many people are calling me crazy the last 4 or 5 months. But the US dollar is crumbling in world influence. And it's being reduced in value because other nations are trading in their own currency. And a lot of oil is being bought with gold right now. So commodity driven. Now, to add to this fire a little bit, Saudi Arabia came out 3 days ago and said that they are now exploring opportunities to sell their oil to nations in exchange for other currencies besides the US dollar. Now, in history, the last 4 countries who have said this have all been invaded. That's just a cold, hard fact. You can look back at Gaddafi. He said he was going to explore taking other currency for his oil. We invaded. I don't think we'll invade. Hopefully don't invade anyone, but obviously the world's a bit of a mess. And we're just here to add some color to it and understand that. But when we look at all the converging factors, right, a crumbling US dollar, supply chain issues in oil and gas, big gas deficits over in Europe, two gas pipelines have been blown up, Nord Stream 1, Nord Stream 2, they've been literally blown up. So there's a big shortage of natural gas, but at the same time, natural gas prices right now are horrible. They're $2.80 for part of the day today. It doesn't actually make sense. I've literally had lunch with economists for weeks, and the best explanation I've gotten as to why natural gas is so low is that it's not very cold in Europe. That doesn't sit well with me. It doesn't sound like an economic indicator, but that is, I guess, the justification out there in the world. So we have this opportunity where we know demand is going to go up. Largely, like when China comes back online, a lot of demand and strain on a supply line. And we know that supply has been depleted. The best place to invest is places where it's a commodity, a tangible asset. Oil and gas are things you can touch and feel and sell in a market where demand is going to rise. So when I look at the opportunity, I'm not an oil and gas guy. I actually come from multiple different sectors. None of them had to do with oil and gas. I'm in this sector because I believe in it. Number one, I believe that we need oil and gas for the next 25 to 35 years before we find an alternative, which is probably going to be fusion energy. But at the same time, I've been raising money in startups and technology groups for so long. I just understand how to raise capital for worthy projects. And I can't find a more worthy project in this country than oil and gas, especially when you add in the tax benefits, the income, and the multiple and capital. So that's kind of a breakdown of where we are. Does that all make sense to you? Just a breakdown of where the market is.
Absolutely. A lot of sense, actually. Learned a lot of stuff that I didn't know, because I was of the opinion that green energy has made a lot of advances, but 85 to 86% or 87 down to 86 isn't like a lot. Yeah.
Well, there were 3 countries, I can't remember which ones, but there were 3 countries this week that actually said publicly they're going to stop shipping electric vehicles because they implode. Most people don't know this, that in order to make a battery for an electric car, it takes 800 barrels of oil. It takes zinc, lithium, and cobalt. And in order to mine enough zinc, lithium, and cobalt to make one battery, you have to move 650,000 pounds of dirt. That's done with diesel vehicles. There's no solar-powered bulldozers that are moving that much dirt. There just simply aren't enough metals or materials on planet Earth to produce enough electric vehicles for every person that already has a combustion engine. It's a very illogical market, very, very emotionally driven market.
So it's going to be a long time before we actually see electric, everybody driving an EV, I suppose.
Well, it's not even possible. Like, no one could. We don't have enough cobalt on planet Earth to build enough electric batteries. I think the latest estimate was like 64%. If we pulled all the cobalt, zinc, and lithium out of the ground in the entire world, 64% of the world would actually have a car.
Interesting. So let's talk a little bit, Eric, about how the investment works. Maybe you want to share your deck and talk through how this oil and gas investment is different in terms of reducing W-2 income or W-2 taxes, and how investors, because oil and gas are traditionally looked at very risky investments. So how do you de-risk oil and gas investments?
Sure. Yeah. No. So most. Because we're all retail investors here, like JP Morgan's not on this call tonight. Most traditional retail investments are what's called 1 to 3 wellbore deals, wildcatting. And this investment's been around for 50 or 60 years open to the public. But traditionally, you're investing in saying, hey, there's this piece of land. I think there's oil there, and I'm going to stick a hole in. And if it strikes, we're going to be rich. And if it doesn't, we're all going to lose. That's how most investments have been made in this industry. Now, over the last decade, the advancements in technology, not just within the walls of our company, but within every oil and gas company and every research firm around the world, there's no myth behind it. We know where all the oil and all the gas in the world are. We have 3D seismic technology that's kind of like a heat map or an X-ray below the surface of the earth where we can determine where the pockets are. So over the last decade, engineering and technology advancements have really been widely ignored by mainstream media. Most of their focus in the media has been on the advancements in green energy, because there's obviously a political angle to this because the stuff doesn't work. It hasn't produced a real return. But when we look at oil and gas, traditionally we'll look at it as risky because most people understand oil and gas investments from wildcatting days, where it was a small group of people that, hey, this piece of land's, there's gold in them, their hills. And they would drill a hole and come up with nothing. So how do you de-risk that? Number one, you de-risk it through technological advancements in science. So, getting 3D seismic and analyzing what the seismic results are, it gives you a 99 percentile of knowing exactly where the pocket of hydrocarbons are. Then you de-risk by getting a team of experienced engineers and folks that have been doing this for a long time. We've been around almost 27 years. And, we've dug through every type of terrain that there possibly is. We're actually getting into a new project that we're digging through chert, which is new to our firm, but not to the people we've brought in. So we've seen about everything and been through about all the different scenarios. We've dug dry holes. We've hit some really big wells along the way. But the days of wildcatting and the big risk, not to say that oil and gas isn't risky, it is. I mean, you're digging, a mile or 2 miles below the surface of the earth and sometimes 4 miles across underneath the surface of the earth to find the hydrocarbons. So there certainly is risk there, but determining where it's at is pretty well de-risked with modern technology. Now, the way you de-risk the investment is something that really only we do. We are the pioneers in the space. I'm sure in the next 2 years or year, you're going to see a lot of copycats from what we do. But traditionally in oil and gas investing, you'll get a call from someone, they'll send you some information and talk to you about these 1 to 3 wells they're going to drill and why it's so great. But at the end of the day, here's how they make their money. Here's a little myth buster for you. So as an investor in 99% of all the deals out there, you're going to invest in an oil and gas project and you're going to own the hydrocarbons once they're pulled out of the ground, and you own a percentage of the revenue. Okay, that's just pretty much how it works. Now, you will get a tax write-off in oil and gas investing since 1984, since Ronald Reagan was in office. IRC 263 has existed, and that's a tax code that allows you 100% write-off for your investment into domestic energy exploration and production. Now, this is really important because the way a company operates determines how your tax advantage happens. So I'm a W-2 employee, and that's what we're talking about is W-2 employees. We're very limited to what we can do with our taxes. The number one, they force us to pay them through our paycheck. And number two, we don't have many options to offset our income. Now, until January of this year, there were what was called conservation easements, which many people know about. They're not allowed anymore. We actually talked to an accountant today, and he said we can't do them anymore. They were banned. Mm-hmm. So there, as far as I know, there's no passive way. Real estate, you can get big write-offs, but you have to prove you've done work and you're a real estate professional, provide all this background. There's no other passive way besides oil and gas to get 100% write-off for your investment. So your traditional oil and gas investment has a big tax write-off for the contribution, and then you own a piece of the monthly or quarterly income, piece of the revenue. But in reality, what's been happening is if these projects are successful, it increases the value of the land in which they've drilled oil. Now, until King operating, all oil and gas operators kept that right to their land to themselves. So the way that they would work is they'd raise money from you, you get a great tax write-off, you get income for 5, 6, 7, sometimes 10, 15 years off of wells. And then the project is worth a lot of money to another developer, and they'll buy the project for 3 or 4x. Well, until King operating, that money went directly to the oil and gas company, didn't go to the investor at all. So what we did in 2015 is we actually changed the model around. So investing with us, we de-risk it by offering the assets. So it's not just if we strike oil, which we're more than confident we will, especially on our horizontal wells, they're 99% accurate. But if we strike oil, you get paid. That's the way they normally work. Well, if we strike oil, you get paid and you're an owner in the assets that we control. So our ultimate goal is to acquire, develop, and divest land. We're always looking to do that. We'll acquire property, develop it. And for us, developing it means proving that the land will yield hydrocarbons. And as that happens, just like you're doing in Salina, right? You have a piece of raw land. The best investment is to buy one property and buy the 4 surrounding properties next to it. And you develop that one in the middle, and the value of the other 3 or 4, they increase immediately because there's more demand. You build an apartment complex on raw land and fill it with renters. Somebody else is going to buy a partition of that land to build a dry cleaner, a grocery store, a laundromat, whatever it may be. We did the same basic philosophy in oil and gas. We include each investor in on the asset base because our primary purpose, again, is to acquire the land, develop it, increase the value, and then divest. So we do 2 different divestitures. The first one, we always divest to an institution, somebody who needs income for their investors, like a pension fund, an endowment fund, a family office that needs income for their mandates. That is used to return principal or capital back to our investors. And then a couple of years later, as we continue to develop, we sell at a multiple to one of the large oil and gas companies out there. So that's, in my opinion, how you de-risk oil and gas. And the great thing is de-risked right away because you get a big tax write-off up front. If you invested $100,000 or $200,000, you're going to get with us, you get about 75% of that write-off year one. So if you invested $200,000 that year, you'd be able to take $150,000 off of your taxable income, saving a ton of money. And you're going to get monthly income from the sale of oil and gas from our projects. And speak with your tax advisor. But that, until you've gotten your principal back in hand, that has general partnership income tax status. So very, very, very lucrative from taxation and monthly income perspective. But again, with us, we're the only place that you're going to find that multiple on the sale of the properties.
So the 3.8x, I believe that's the multiple you guys offer. So is that include it's because of the sale of the land as well?
Well, it's not that we offer it. So we can't offer something we don't have. It's our projected. Yes.
Wrong word.
We're recording.
We're recording.
So we project a 3.5x multiple on the properties we have because these are properties that are state-owned or privately owned. So we don't have to worry about federal interference. That's a really big thing to look at. We also look at properties like right now, the 2 properties we have in this fund have a total estimation of $840 million worth of hydrocarbons underneath the land. So there's a tremendous amount of revenue that we can pull out. And the purpose is we want to pull it out, get our investors, 14 to 20% per year on their monthly income. That attracts buyers, right? Just like if you have, you go from 30% occupancy to 90% occupancy, your offers on that building are going to go up significantly. So we're looking at the same type of model, and we're looking for 3 to 5 years total exit. So, most oil and gas investments are 25-year investments. That's just kind of the average number. Your average oil well is going to go from 20 to 30 years. So we're looking to take a piece of raw land, convert it into an oil field or an economy of scale, and be able to shop that property to the appropriate purchasers in the future, getting everyone a multiple.
Gotcha. And so I had a question. I think I forgot. So the monthly income, for example, will depend on the price of the commodity in the market, right? The monthly income that investors are going to get.
Yes, especially early on. So in oil and gas, the fundamental theory, prices don't matter to those who produce, right? So the more we're focused in on, like this year, we're looking at drilling 18 to 20 wells just this year. You're talking 1-2 a month going for the entire year. The purpose of that is to get high production value. So if we get $50 a barrel on 1 million barrels, that's better than getting $80 a barrel on 100 barrels, right? But early on in the fund, commodity prices certainly impact monthly income.
And later on, how does that change? Sorry, you said early on.
It doesn't change. It's just the economics behind it. The more we produce, the less impactful it is month to month. But it certainly does have an impact early on in a fund when you have your first well or first 2 wells producing. But the good news is that between, I was saying this for about 6 months, but now you have at least 100 analysts out there that are projecting oil to be well over $100 on average in 2023. Some of them are projecting 140 to 200. And as I explained early on, that's how you get there. Oil and gas is very supply and demand determined. When supply is low and demand is high, the price goes up. So we're definitely looking at 2023 all the way through 2025 being, a 3-figure market for oil and between $6 and $8 a unit for natural gas. Once whatever's happening in natural gas is leveled out, because there's really no explanation for it being this low.
Excellent. And I think there are some questions coming in, so I'm going to start talking about those. Do you own the drilling equipment and operate the wells?
We operate, we don't own. So that's another way that you diversify risk in oil and gas is that, we carry a $20 million liability policy as the operator, the sponsor of the fund. But in oil and gas, really the only people who own their equipment are like Exxon and Shell, and they don't allow, retail investment. They work with institutions. So on our level, the independent drilling side, not only do we rent things, that's part of the reason we raise capital, but every time we rent them, we actually get to share the write-off with you. So in order for us to get a 75 year one write-off for the tax advantage, we have to spend money. And that's, called tangible and intangible drilling costs. I'll be happy to do it when we go through our deck.
Yeah.
But for the
share your deck, Eric, because there are a lot of questions coming in on the investment opportunity, minimum investment amount, returns, and I think the deck will probably clarify that better than us talking through it.
Oh, I can't. I was just told we were doing education today, so either way.
No, we can talk a little bit about the deal. I think we talked a lot of the education stuff, but we can cover the deal a little bit.
Sure. Let me share my screen here real quick. There we go. Can you see?
Yes.
Okay. Well, I'll skip the formalities and obviously read disclosures, disclaimers, PPMs, decks, everything that we share with you. But our fund right now, we're in the middle of a $200 million asset raise, and that's with a projected $1.05 billion total valuation for the two pieces of property we have now. However, we're raising money frantically right now. I mean, right now, some great buying opportunities with low commodity prices to get another 2 oil fields included in the fund, but we're raising 200 million to turn it into 1.05 billion estimated. And again, that's kind of our acquire, develop, and divest slide. Our process kind of went through that. Basins of focus, I'll get into the specs. So right now we have properties in the Permian Basin and in Wyoming. For those of you who haven't heard of the Permian Basin, it's kind of like the Yankee Stadium of oil and gas. I mean, it's really this long-standing, there's so much oil and gas underneath the surface of Texas alone. Between Texas and Alaska, there's enough oil and gas underneath both of those two states' surfaces to power every car, airplane, manufacturing center, school, electricity grid throughout the entire world for the next 600 years. So I know that the media will tell you that we're running out of oil. I mean, I think it was, I forgot who it was, but somebody said in the 60s that we'd be out of oil by the 80s. We're not out of oil. That's an untruth that's been told to you. But the fact of the matter is there's a ton of it there. So we have a great project in Borden County, Permian Basin right now, one property owner, one mineral right owner, very easy to permit. But our total fair market valuation on between that and the Bighorn Basin and Wyoming right now is already a little over $1 billion. Again, there's $840 million worth of revenue underneath the surface of the earth across 36,000 acres. It's a really good product mix, about 50-50 oil and gas. And we already have 200 identified drilling locations with 18 of those that are called drill ready. Drill ready means that we file one permit. It takes about a week to get the permit approved and we're ready to drill. So we're really excited right now because we start drilling next week in Permian Basin. So we are already, getting into the dirt and going below the surface here in the next week. Again, our PDP, which is proven, developed, and producing wells, we're targeting 18 to 21 of them in the next year with a total of 40 what are called proven undeveloped wells. So these are wells where we know that there's oil below the surface and we're preparing the surface for future drilling. These things have real value. It's almost like buying raw woodland and ripping down all the trees, preparing it to build an apartment complex. Even if you don't build the apartment complex, you're going to make a very good return on your money for preparing it for the next builder. So that's where we're at with the fund. The way it breaks down, the Permian Basin, we plan on drilling 8 wells there. Again, the first well starts next week. There's a total of about $50 million per well. So each well in there is about $50 million in hydrocarbons we can pull, giving us that valuation. In the Bighorn in Wyoming, we won't start drilling there until after the winter. I don't know if you've been to Wyoming in January, February, and March, but it is I think only penguins live there. It's like really, really cold. So we avoid cold drilling. It's just much harder to do, harder in the drill bit. But as it warms up a little bit and the surface area starts to loosen and warm up, there's a massive, massive pocket of natural gas there. And we have almost 4.6 million units of natural gas that are just up in Wyoming waiting for us to get into it. So that gives us our $840 million valuation with $1 billion total fair market based on the proven undeveloped or PUDs that will develop along the way for either us to continue drilling or for a new buyer to use. They provide a tremendous amount of value. This is an important slide because we're dealing with investors. So again, 100% write-off. I'll walk you through in the next couple slides how that breaks down. 100% write-off for the contribution. One thing I can guarantee you, Kavitha, is that in 2023, they're going to raise taxes, okay? Before I even get into this, it's important to note that the debt ceiling was not voted to be raised. Most people don't know what that means. The debt ceiling is the credit card that Congress has to print money. Okay, we're not raising that. We've already passed it. So we owe more than we're allowed to borrow as a nation. This country is $33 trillion in debt as we speak, and our bond market is almost illiquid. Nobody wants our debt. So as this happens, what we're going to see, and this is a projection, and I'll be happy that this is recorded because we'll see if this happens. What I think is going to happen over the coming year with interest rates, which is very important, is you're going to see high inflation, and now they're raising rates, and inflation is lowering. At least the inflation they tell us about is lowering. But what's going to happen is you're going to see political pressure begin to build for them to raise, and now they're saying eliminate the debt ceiling. That's probably going to happen with political pressure. Okay, it's just a harsh reality of politics. When that does happen, so let's just hypothetically say that there's enough political pressure because no one can borrow money and it's really expensive and there's a lot of pain and people complain when there's pain and they want their pain removed immediately. Instead of correcting the economy, we're probably going to raise the debt ceiling at one point or eliminate the debt ceiling. What that does right now, our debt ceiling is met. We've capped out our credit card. They will not lend us any, they will not print any more money. By not printing money with high interest rates, inflation will go down. That's just how it works. But if they eliminate or heighten the debt ceiling, they're going to print more money. So when they raise the debt ceiling and print money, they're going to lower rates, and that's going to increase inflation even further because inflation is created by printing money. So if the desire of our Congress is to want to print more money, which doesn't go to the United States anyway, print more money that we owe as taxpayers, right now it's a certainty when we can't borrow more money to pay off our interest payment to the Federal Reserve, they have to raise taxes. They call our taxes revenue. It's the Internal Revenue Service. We are the revenue source for our politicians to borrow money from the Federal Reserve. So it is a guarantee in 2023 that they will at least try and probably fulfill the need to raise taxes. Your taxes in 2023 should be the primary focus of protection. I believe it is our fundamental right as Americans, our duty to not pay the IRS because the IRS does not pay us. So if we focus on ways to lower our taxable income in 2023, we'll be way ahead of the game. Now, on the other side, if they're going to, they're going to do, I estimate they'll do 2 more small 25 basis point interest rate rises, and then you'll see the inflation drop, at which point in time they will print more money. They will. And when they print more money, inflation is going to skyrocket because it hasn't been corrected. It's just been band-aided. And when that happens, they're going to have to start raising interest rates even faster in the future. So I see the second half of this year being very painful for the lending market. I see that being very apparent to me. But the fundamental truth behind all of that is our country borrows money from a Federal Reserve that isn't part of our country and collects money from us to pay them back. If they're going to print more, they're going to owe more. They already owe $33 trillion and they have no new sources of revenue. Your taxes will go up. So an investment like ours, as far as I know, is the only 100% write-off for a contribution into an investment that will do good things for your family. Okay? It's the only one I know of that has any sort of actual monthly payment with a multiple and a tax benefit. Now we're shooting for, in all of our funds traditionally, we get to about a 14 to 21% annual return. On a $200,000 investment, that equals about $2,300 to $3,500 a month. And again, extremely tax advantaged until you've recouped your principal. And we're looking at a 3.5x total return over a 3 to 5 year period on the fund. So a $200,000 investment would end up being a little over $700,000 in your pocket. And this is how it would break down. Again, a $200,000 investment, if you got 75% year one, by the way, after year one, it's equal for the next 4 years. So we have a lot of investors that invest in oil and gas once, twice, sometimes 3 times a year to manage their taxation. And they carry for another 4 years, the remaining 25%. So it's a constant way to manage your taxes. And in the highest tax brackets, it equals about $60,000 from $200,000 cash on hand back in your pocket by not having to pay the IRS. This is the way that we split up money. So as hydrocarbons come out of the ground, it's important to know how this works. So we pay the royalty owners first. And again, we work with private and state-owned land, so we're not interfered with by the federal government. After that, the guys who actually pulled it out of the ground, they get paid. And then that leaves us net profit. So of our net profit, until your principal is returned to you as an investor, 80% of our net profit goes back into your hands. Once principal is returned to you, it switches to 60-40. And the reason that is because we make our money on the back end of the deal, right? That's how we make our money. And as far as we know, we're the only oil and gas company around that even offers a multiple on the land. So while we raise the capital and shut down new investment, once we've gotten principal returned to you, it's important that we have a little bit more cash on hand to continue developing the project to get you that 3.5x return. And this is a simple breakdown. I'm sure you've seen this. We can share this deck with you. But I don't want to get too deep into our deck. I think this is important for real estate people to understand that on the exit, this is how it works. This is our comps. Like we love to be relevant in the audience we speak to. So there are comps for what we do about 20 to 30 times a month in oil and gas. Most recently, Northern Oil bought a piece of the Mascot project in Midland. They paid $330 million for 36% of that fund. That's what we look to do first, is to sell to somebody who needs income, a portion of the fund itself. So you'll get your principal returned to you. And again, there's no guarantee of any of this stuff, but that's obviously the goal. We've done this a couple of times, but that's our goal. And at that point, you're still receiving monthly income, and you're going to get paid a multiple when one of these private equity companies or one of these major oil and gas companies, who, by the way, have no incentive to drill oil right now. If you look at the pricing of oil and gas companies that are publicly traded, they're getting less than their net asset value for share price. So they're not drilling oil. They're using their cash reserves to buy their own securities back, share buybacks from investors, so that when the market turns, they'll drill and really profit. So groups like ours, we are drilling oil. So if they're not drilling oil and buying back shares, they're stocking their cash to be able to purchase properties like ours when they're completed. So we're really in the exact right time in history for what we're doing. And I can get all that other stuff, but I kind of want to stick on the education and market and focus there. But does that help you out a little bit?
Yes, for sure. I have a quick question, Eric. On the exit value, how is the exit value calculated? Is this based on how much oil production? And is there something similar to cap rate in real estate on how the wells are oil or the land is valued?
Yes. So it's very similar, but with different metrics. So every time you pull oil out of the ground and sell it in the market, you're raising the value of all the land. So the problem with us is that it's provability. So we know there's oil and gas there, but will the land yield it? So our engineering becomes ultimately the most important piece of the puzzle. We'll find a piece of land. We know that there's hydrocarbons, but then there's still risk of, will the land allow modern technology to be able to pull it out? And once you do that in one area of a huge, you're talking 36,000 acres of land, this is a huge piece of land. Once it's proven in one piece of that property, the whole rest of that property is proven. So every time our multiple is created by revenue, dollar for dollar, it's created by future development. So the ability to create proven undeveloped wells or PUDs, that's a big piece of the equation. Commodity prices at the time. So obviously we wouldn't sell right now. This isn't a great time to sell. But as commodity prices are higher, you want to sell it for sure. And then, of course, the geopolitical has a lot to do with it. Right now, our land doesn't have great value in commodity pricing yet, but it has great value being added because of scarcity. So right now, you can't drill on federal land. You have to find land like ours. So eventually, that scarcity will dissipate. They'll start drilling federal lands again. That certainly has to happen. Otherwise, we're doomed. So that will happen. And that should happen to coincide with high commodity prices. And at the end of the day, the price of commodities has very little to do with the valuation. It's the current and future production that people pay for. So they're going to look at it and say, well, you've done X amount of hundreds of millions of dollars in revenue, and there's still all these available reserves that you've prepared for us. And they pay for that service that we've done early.
Gotcha. Okay. That's very informative. Why would a major company buy from you instead of doing the same thing as you do? Ask anonymous attendee.
Anonymous attendee, great question. Number one, the properties that we touch are always adjacent to other properties. So we look at wells that are in an area where wells have produced, right? It's part of our breakdown of how we look for new property. Big companies, they do big things. So from us coming in and buying a $50 or $100 million piece of land, that's peanuts to them. So they're looking for the billion, $2 billion, $40 billion plays. But right now, the answer is traditional that way. But right now, the answer is that publicly traded energy companies are not being rewarded for drilling. It's not happening in share price. You can look at any major company, their share price is not correlating with their net asset value. So if they're not being rewarded to drill, they're buying back shares. We went to the Hart Energy Conference about 2 months ago, and all the majors said that they're projecting 0 to 5% growth over the coming 5 years. That means they're going to be using their capital to buy back shares, own more of their own company, and when the time is right, they'll have cash available to buy projects like ours and begin drilling again. So it's a question I asked even when I started in the industry, why us? And, we're kind of like I guess you could look at it as the minor league system. We're the ones who come in first, develop the land, and they're the ones who have the really big capital, the billions and billions of dollars behind them to be able to drill 6, 7, 10 wells simultaneously, where we can do 1 or 2 at a time. So that's a very good question, though.
So is there more risk since you guys are sort of the pioneers, you figure it out and then they come buy from you? Is there more risk in the process? Because is there more risk that you take on than they do because they already know it's proven?
Sure. Yeah. I mean, we're de-risking. We de-risk the way that we've set up our fund and the way we operate de-risks for investors. But investors get paid for risk. I mean, that's how it works. So yes, we are de-risking the land. They'll know that it's profitable, that it yields, that it will provide income. So I never really thought of it that way, but yeah, we are de-risking for some of the bigger players, but they pay a multiple for taking less risk.
Right. I mean, it's kind of similar to, we entitle land. I mean, obviously we take on more risk, it's worth more after entitlement. So
sure.
You're getting higher returns because you're taking on a little higher risk. I think someone asked a good question here. What has been your historical performance in the recent past? Like, have you guys gone through a full cycle on any of your funds before?
Yes, we have. I'll actually pull that up for you. There we go. Share my screen.
Yeah, I think there were a couple of questions about previous projects that have gone full cycle. So
yes, we have full breakdowns. You can see my screen again?
Yes.
Yeah,
we can share these slides with the investors as well. So
yeah, so here's the historical performance since 2015. So early on, when it says closed up there, it's closed to new investment. So once we hit our number, sometimes the numbers change. Like we raised extra money for our last fund because of inflation and supply chains. Everything in every industry is more expensive. I mean, that's how these economic cycles work. But 2015, we did our pilot. So we started out by raising $4.5 million in equity, and we ended up selling in 19 months for $13.5 million. So that was fully executed from investment to divestiture. We also had a fund from 2018 to 2020 that we call Hard Lessons Learned. We ended up having to borrow money along the way from private equity, and then a pandemic hit. So we had massive, reduction in manpower and equipment availability, supply chain issues, and it caused us to miss one of our covenants on the loan from the PE company. So we actually lost control of operations in that, which isn't uncommon in our industry. But that fund itself is still producing. It's still available and out there. It's a good deal. It's just something that we failed on one of our covenants. And I say that we failed because that's the fact, but the reason or excuse, whichever way you want to see it, is that we literally ran into a pandemic. About 50% of independent drillers went out of business, and we're still here. So we did something right in a very difficult time. But then we used that same market in 2021 to go out and buy 152,000 acres worth of land for our last fund, which we closed in August. And right now our numbers are down a little bit. Production's down. We have 11 wells that are being drilled right now. 2 of them just came online. Our investors are going to be very happy when we come late spring, early summer, because of the late investment we brought in. But oil and gas isn't like a normal business. We'll raise money today and we won't see any return for 2 or 3 months, sometimes 4 or 5 months, because we are drilling miles below the surface of the earth for one of the most needed commodities in the world. So that last fund right now, we're probably in late summer going to start shopping as the production increases. That has to happen first. We have to have a big, 25%, 30% annual yield. Once that happens, we have a bunch of opportunities to start speaking with endowment and pension funds and do our first divestiture there. And then now we're in fund 4 of this new model that began in 2015. And we're about, I think we're at $42 million of 200 million raised since November. So there's tremendous appetite in the market for what we're doing. And again, we're breaking ground and start drilling next week. So that's a good snapshot of our track record in this model. Now we have 25 years before this that we were doing the 1 to 3 well deals, and like everyone else was doing. And we had some really big hits, and we had some failures along the way over 25 years. That's just part of oil and gas.
So there was a question here. Did people lose money in the fund too? The LP Larimer County Fund? No,
one of the things we did with that was we realized that, we had our investors in there. We grandfathered a lot of them into fund 3 or into our fund 1, program 3. So we grandfathered a lot of them that got put on a stalemate. That's literally the pandemic just shut down almost everything in our industry. I mean, oil was trading at $39 a barrel during the pandemic. So there's some significant issues there, but we grandfathered our investor. One thing about our firm, I will say, is that number one, we're not afraid to say that we're imperfect. Number one, and number two, we're also not afraid to do the right thing. So in our fund 1, program 3, we actually did an $800,000 divestiture. We sold a handful of wells to another provider that needed them to add to their property before they sold. We gave 100% of that to investors. So 100% of that divestiture went out into the hands of the investor. The company kept $0. So yes, we certainly have a blemish on our track record. Not unusual. If any oil and gas company tells you they've never had a failure, they're lying to you. That's a fact of the matter, but we don't try to hide from it. It's certainly a new model and a new, we were very excited. I wasn't here, but I can tell you the excitement I've heard from people here in 2018 and 2019. They were through the roof excited. And then, one day we all woke up and governments around the world said, no one go to work or do anything for about a year. And that killed our deal there. So, but we did the right thing. We grandfathered our investors into the next fund, and they've been receiving income checks since June of 2021.
Awesome. All right. Lots of questions coming in. So I don't know which one to take first. So is there 100% write-off, or is that tax just deferred? I think that's the question.
So it's a reduction in income. So again, if you invest $200,000, generally year one, I mean, for 15 years, we've produced a 75% year one. So 75% of that reduction in income will come year one. The remaining 25% will be spaced out over years 2 through 5, but they roll. So it's not like you get one. You can keep investing in oil and gas every year, and by year 5, you probably get a refund. But yeah, it is 100%. It is a reduction in taxable income.
Right. But there is no recapture like depreciation, right? It's just a write-off. And is there a recapture? Let's say investors will get the 3.5x, but is there a recapture of that depreciation? I think that's what they're asking. Or
yes, there is a recapture, but thankfully groups like ours, we have an 8-fund process. So over the next 9 years, we'll be launching 8 of these funds. So the recapture is only on the original amount. So everything over the original amount is capital gains. But you can actually 1031 into new oil and gas funds. We're actually launching a fund out this summer where you can use multifamily exit or a 1031 profit and move it into oil and gas to continue to roll through. So there is a recapture, but oil and gas has 1031 exchanges.
Okay. But the write-off, let's say I put $100,000 in, and let's say I'm in the 40% bracket and I save 40,000. Is there a recapture of that taxes that I save? Because in passive depreciation, there's a recapture when the property is sold. So when the investors are cashed out, is there a recapture of that amount, I guess?
Yes. But again, that's why we keep new funds constantly available.
So you invest again and yeah, gotcha.
Correct.
So the taxes will be paid on the total profit. Obviously, the principal return is not taxable, right?
Well, we don't call it principal return, and I don't want to get too deep into taxes, but yes.
Yeah. Okay. Does it also offer, I don't know if this is a CPA question, but does it offset state taxes like in California, New York? Do you know
Yes.
off the top of your head? It does.
Yes, it's a reduction in taxable income.
Income, and that rolls over to the state tax income as well.
That's
Okay.
correct.
So there's multiple questions on that. Mentioned something
They're
about
definitely from people in New York or California, because I
Yeah.
moved to California and I can't tell you how happy I am to keep 13.5% of my income.
So multi-year write-off, you said the first year you have a certain percentage and then you'll get more write-offs on the successive years. What was the split again?
So if we got the 75%, which we get year over year, and by the way, oil companies will tell you 90%, 95%, and I've seen 13% return, meaning they're not spending the money in an appropriate manner for their investors. But the way that we structure everything, our money is spent within a month. So capital raised is put into the ground. We want to buy out supply chains and avoid inflationary costs as much as possible. So the faster people invest, the more profitable the fund actually is. But the way that the following years are, they're based out equally. So if we got 75% year one, you would have 25% remaining that would be spaced out over 4 years. So a little over 6% a year for the next 4 years.
Gotcha. I think the person on the tax break as asking what the tax rate on the recapture is. Do you know off the top of your head, or we can just shelve that and say, please consult with your CPA on that?
Well, you always should. But I think that question is better answered. So Rex Gifford was our CFO for 15 years. He's from the IRS and is an oil and gas specialist. When we do a full deck presentation with you guys, he'll be on with me and you can ask him really detailed questions. Okay. That part I know the answer, but I don't want to say it the wrong way. So I would certainly refer to a tax professional.
This one's an interesting one. Would you use it for investing from an IRA? I feel like you're losing some of the tax benefits, right? That's the biggest part of it.
Well, Rex will explain that in detail, but investing through an IRA could actually create a taxable environment in an area you're supposed to be getting a tax write-off from. We do have people quite often that pull money out of an IRA, or if they left a job, they have a rollover, they'll put in an IRA and pull it out because you get taxed on it. But then you reduce the taxes by the investment, so it counteracts itself over a 2-3 year period. Plus, the
income allows you to pull money out of retirement without the taxes. Gotcha.
Yes.
Would they be investing as an LP or a GP? And if they are investing as GP, which I assume they have to do to get that active income tax break, what kind of liabilities would they carry?
Great question. We get this all the time. So yes, to get the big tax break, you have to be a GP. Mm-hmm. So all of our investors come in as GPs as the funds are being accumulated. And again, they're put into the ground very quickly. I mean, our role in this country, this economy, and in your lives is to drill as much oil as humanly possible, as quickly as possible. So in that event, everyone's a GP to get the big write-off for year one. You can come in as an LP, but then the concern becomes liability. As a GP, everyone likes the tax benefit, but liability is the issue. It's not an issue once you understand how it works. So every piece of the drilling process is completely offset by contractors. So again, we carry a $20 million policy, which has never been used in the state of Texas. The policy that every oil and gas operator has never been dinged, because when we hire someone to prepare the land, they have a $20 million policy. When we hire someone to drill, they have a policy. So each component of drilling, all along the way through piping, flowback, fracking, every one of those is done by a contractor that we operate with. So as they come in, they're protected by the insurance in case something went catastrophically wrong, which has happened a few times, but it's not all as common as you think. But if something happened, their insurance would be liable. If the claim exceeded their insurance, then it would go to us, and our insurance policy would cover that. So from a logical person, you'd think GP risk, but in oil and gas, every component, we hire about 97 contractors to drill a well. That's 97 other insurance policies for each piece of their process. That's covered not only by them, but also by us. Now, as all of the funds are deployed, the moment the last fund is deployed, every investor, with the exception of King, ends up becoming an LP. So we're only using the GP process for the big write-off. We mitigate the liability by the way that we structure our operations. And then as soon as all funds are deployed, every investor is converted to an LP the following January 1st.
So can they still get the rest of the write-offs, like 25%, even
Oh,
though they're
absolutely. Yeah,
okay.
absolutely.
So I think the answer to this question is you don't wait to fully fund a project until you start investing the dollar, right? So let's say you get in a couple of 10 million and you don't get the entire 100 million. Does the project still kick off? Is it deployed, the money?
Yeah, we're raising 200 million. We started essentially on November 1st. And we have about 42 million in the door already. About 38 million of that's been deployed.
Mm-hmm.
So we start drilling as soon as money comes in. So the project's already going. We don't wait for full completion of funds. We have the opportunity anytime we really want to work with broker dealers. We could raise 100 million super fast. But we're working with different institutions and high net worth investors and groups like yours that have high net accredited investors. We have such a big market to tap right now for the next year. We will complete the 200 million. We might actually raise more because this fund is another benefit I didn't mention. Number one, our oil is not tied to futures contracts. We own our inventory. So if prices aren't good and we have inventory, we'll let it sit there until prices come up and profit properly for everyone. On the flip side of it, this fund, we're not taking on any debt. You know, we went from PE debt that didn't work out great with the pandemic into bank debt at 4%, which is fantastic. But this fund, we're doing zero debt. We don't want to put anyone at risk, especially ourselves, for interest rate environments that are volatile. So we're raising 100% of this fund on equity, no debt. So we may end up raising 250 million by the end of the year. We might overfund the project itself just to create certainty, because with supply chains and inflationary rates, our last fund's already more expensive than it was when we calculated. So we will avoid debt at all costs. And that keeps us in a very good position for profitability moving forward.
Makes sense. Awesome. Yeah, I'm going to ask about the debt because that's a big problem right now, but it's
No
good
debt.
that we don't have to worry
No
about
debt.
that. So are capital calls expected during projects?
No. I mean, that's a super fast gunslinger answer. No, we've been in business 26 years. We've never had a capital call. You will see them in our PPM. They are a possibility in the future, but we've never conducted a capital call.
Okay, awesome. The last question I see here is, what's the subscription timeline of the current offering?
So all of our funds are structured the same, and we look for a 3 to 5 year total timeline on the subscription. So we're looking to exit out fully within 5 years of inception. So from the moment we complete the capital raise, 5 years after that is our longest extended timeline. So we're always looking for that. We do expect to complete the funding or the initial capital raise into this project by early summer, late spring. And that will kick off that 5 year time horizon. And by then we should already have anywhere between 3 and 6 wells drilled and producing. So we do move very fluidly as capital comes in. We've got a very strong operational team and drilling team and a very strong plan moving forward. So every month that we raise capital, we keep drilling wells from inception to completion.
All right. So is there a specific time that the capital raise is closing? Like they have to fund by a certain time, or is it just going to be an open fund?
Well, I will say this. So right now, here at the end of January, we may extend it, but we're offering a little bit. Normally we do a 60-40 on the exit. We're offering a little bit of a bump there as an incentive in January, maybe through February. But then we also have the possibility of priming or creating a new prime rate for the fund. So as we start producing income and our income is stable, the price of entry will go from 200,000 a unit to 220. So getting your money in early, there's incentives to do so and protection of pricing in the future. Also kind of a thank you to early investors that they'll see a raise in unit price. But in general, we're looking at, late spring, early summer for completion of funding on the timetable. But we're looking at production or revenue beginning in late March or April. So March or April, you'll start receiving monthly checks. That makes the offering far more attractive in the market. So we can't guarantee you the same pricing, but I'm pretty confident that we'll have an opening for investment basically through the beginning of the summer.
Okay. I think that's all the questions I have. I know we've gone a little bit over, and thank you, Eric, for hanging in here and getting through the questions. I appreciate that. If there are no other questions right now, I'll just throw the a link to the interest form. You guys can sign up, and Cole and their team will contact you if you are interested in investing with these guys. I also will post a link in the chat. I'm trying, it keeps wanting to autocorrect. I hate autocorrect sometimes. Bit goes to but. I'm really trying. All right. So it's only going to hosts and panelists.
Oh, it's in there now. I see it.
Yeah. I tried it again because I have to send it to everybody. So the link is out there if you guys want to go. Thank you guys for joining. As always, I really appreciate you taking time out from your busy lives to join us for these webinars. And thank you so much, Eric, for spending all this time with us and talking about really details. I learned a lot of stuff today, so I appreciate your time. Thank you.
Absolutely. Thank you, Kavitha. This is great.
Thank you. You guys have a good night, and I will see you in 2 weeks. Hi, I'm Kavitha Bartake. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.